They said the 1920s were unstoppable, an age of wealth, confidence, and dreams. Stock prices could only go up. People mortgaged their homes to buy stocks. Banks lent money they didn't have, and everyone, from factory workers to millionaires, believed they were part of a new golden age. But then, it vanished. In just a few days, $30 billion in wealth disappeared, the equivalent of over $500 billion today. Fortunes evaporated. Banks collapsed. Families starved. The world had entered the Great Depression, the darkest economic chapter in modern history. But here is the mystery. How did a decade of unprecedented prosperity turn into global ruin almost overnight? And more importantly, could it happen again? The 1920s were called the Roaring Twenties, and for good reason. World War I had ended, and America had emerged as an economic powerhouse. Factories were humming. The stock market was booming. And for the first time, the average citizen could invest. But underneath the celebration was something dangerous. An illusion. Banks had begun lending money to almost anyone who wanted to invest. You could buy stocks on margin, meaning you only needed to put down 10% of the price. The rest, borrowed. So if a stock costs $100, you could buy it for 10 and borrow the remaining 90. As long as prices kept going up, everyone won. But if they fell, you'd owe more than you owned. By 1929, more than 40% of all stock purchases were made on margin. People weren't investing in companies. They were gambling on hope. The Federal Reserve, still new at the time, didn't fully understand how to manage such speculative growth. Interest rates were kept low, fueling easy borrowing. Banks took massive risks, and corporations manipulated stock prices through insider deals and fake press releases. It was a financial bubbala pyramid built on confidence, and every pyramid has a tipping point. By 1928, the stock market had become a national obsession. A famous economist declared, "Stock prices have reached what looks like a permanently high plateau." Magazines featured stories of secretaries becoming millionaires overnight. But as wealth surged, inequality exploded. The top 1% owned nearly 40% of the nation's wealth, while most Americans lived paycheck to paycheck. Major investors quietly began selling off stocks, while encouraging the public to keep buying. Wall Street knew the game was almost over, but they needed someone to buy their shares before the fall. That someone was the average American family. It began quietly. In September 1929, stock prices wobbled. Confidence cracked. Then came Thursday, October 24, Black Thursday. Panic swept through Wall Street. 12 million shares traded a record. For a moment, it seemed the storm might pass. Then came Tuesday, October 29th. That morning, 16 million shares were dumped. Entire fortunes disappeared before noon. One broker said, the tape couldn't keep up. It was like watching the end of the world. The market had lost over $30 billion in value. But this wasn't just a market crash. It was the collapse of trust. After the crash, the dominoes fell. Thousands of banks had invested heavily in the market. When stocks collapsed, their reserves vanished. Depositors rushed to withdraw savings, but the money wasn't there. By 1933, over 9,000 banks had failed. Life savings gone overnight. Unemployment rose to 25%. 1 in every 4 Americans had no job. The Dust Bowl turned millions of acres into wasteland. And it didn't stop at America's borders. European economies collapsed, helping fuel the rise of radical new powers. President Herbert Hoover believed the market would correct itself. But patience didn't feed hungry families. Shantytowns were mockingly called Hoovervilles. In 1932, voters demanded change. That change came as Franklin D. Roosevelt's New Deal. He created the FDIC to ensure bank deposits, the SEC to regulate Wall Street, and Social Security to protect the elderly. For the first time, the government acknowledged something radical, that markets couldn't be trusted to regulate themselves. And yet, recovery was slow. It wasn't until World War II that America's economy finally roared back to life. So what really caused the Great Depression? The roots are painfully clear. Speculative greed, unregulated banking, and wealth, concentrated in the hands of a few. It wasn't one bad day on Wall Street. It was years of ignoring reality. Now, here's the uncomfortable question. Did we ever really learn? In 2008, a similar story unfolded. Banks lent recklessly, people borrowed beyond their means, and markets soared on illusion. Then, the bubble burst. Over 8 million homes were foreclosed. Trillions in wealth vanished. Sound familiar? Even now, we see echoes everywhere. Speculative manias, tech bubbles, and rising inequality. Every generation believes asterisk, but history whispers. It's never different. So, what can we learn from the collapse? First, wealth built on debt is fragile. Second, confidence is the real currency. The economy isn't powered by money. It's powered by trust. And third, greed never learns. But people can. Recognizing the pattern is the only way to avoid being swallowed by it. In 1929, people said the economy was too modern to fail. In 2008, they cited it was too big to fail. Today, they say it's too connected to fail. But the truth is, every empire built on excess eventually falls. The Great Depression wasn't just an economic disaster. It was a mirror, reflecting our endless cycle of optimism and denial. The next collapse won't come with warning bells. It'll come disguised as another golden age. The Great Depression erased generational wealth, but it also revealed a timeless truth. Progress built without balance will always destroy itself. It taught us that no system, no matter how powerful, is immune to the flaws of human greed. So the question isn't, could it happen again? It's will we recognize the signs when it does. If you found this story super interesting, subscribe to join us as we uncover the hidden lessons behind history's biggest turning points. Because sometimes, the past doesn't just echo, it warns.